You need to see this chart, because what just happened in the silver market? It's only occurred twice in modern history, and both times what followed changed everything for precious metals investors. Silver just broke above $50 per ounce. Now, if you're not paying attention to silver, you might think that's just another price move. But here's what makes this absolutely extraordinary. The last time silver traded at these levels was January 1980. That's 45 years ago. Think about that for a moment. Ronald Reagan hadn't even taken office yet. The internet didn't exist. Most people reading this weren't even born. But here's the part that should make you sit up and pay attention. In 1980, silver didn't just hit $50 and stop. It went parabolic, from $6 to $50 in less than a year. And the conditions that drove that move? They're not just similar to today. In many ways, they're worse. Let me show you exactly what's happening right now. Why this breakout is different from anything we've seen in decades, and what it means for anyone holding dollars, retirement accounts, or trying to preserve wealth in this environment. First, let's talk about what actually happened in 1980, because the parallels are stunning. Back then, you had rampant inflation. The dollar was losing purchasing power at a terrifying rate. People were panicking about the stability of the financial system. Sound familiar? But here's what most people don't know about that silver spike. It wasn't just retail investors piling in. The Hunt brothers, two Texas billionaires, were accumulating massive physical positions. They understood something that most people missed. They saw silver as real money in a world where paper currency was being destroyed. Now they eventually got crushed by the system. The exchanges changed the rules mid-game, raised margin requirements, and forced liquidation. But before that happened, silver went from $6 to $50. That's more than an 8x return in less than 12 months. And the people who got in early, who understood what was coming, they made generational wealth. Fast forward to today. Silver just broke through $53. That's higher than the 1980 peak when you adjust for the brief spike. But here's what's different this time. The supply situation is far more critical. In 1980, there was still plenty of silver available. Mining production was strong. Inventories were adequate. Today, we're looking at a completely different picture. Global silver mine production has been declining, not growing. Declining. At the same time, industrial demand has exploded. Solar panels alone are consuming silver at rates that would have been unimaginable in 1980. Every solar panel requires about 20 grams of silver, and the world is installing solar capacity at record pace. Then you have electric vehicles. Each EV uses roughly twice as much silver as a traditional car. The electronics revolution, 5G infrastructure, medical applications, water purification. The industrial demand for silver is relentless and growing. But here's where it gets really interesting. The COMEX, the major exchange where silver futures trade, is showing something remarkable. The amount of physical silver available for delivery has been dropping steadily. We're talking about inventories that are a fraction of what they were just a few years ago. And at the same time, the number of contracts demanding physical delivery has been rising. You see, most silver trading is paper. Futures, contracts, ETFs, certificates. Very little actual metal changes hands. But when people start demanding physical delivery, when they want the real thing instead of a paper promise, that's when the system gets stressed. And that stress is building right now. Let me give you some specific numbers because this is where it gets wild. The total amount of silver held in COMEX warehouses is around 300 million ounces. Sounds like a lot, right? But here's the context. Global industrial demand alone is over 500 million ounces per year. Investment demand adds another 200 million ounces. And mine production? About 830 million ounces annually. The math doesn't work. We're consuming more silver than we're producing, and the gap is being filled by above-ground inventories that are shrinking fast. Now, central banks aren't buying silver the way they're buying gold. But institutional investors are paying attention. The silver ETFs have seen significant inflows. And more importantly, the smart money, the people who understand commodity markets and supply dynamics, they're positioning for something big. Here's a story that illustrates what's happening on the ground. A major silver dealer in the United States reported that in recent months, they've had trouble sourcing physical silver to meet customer demand. Not because people aren't selling, but because the premiums on physical silver, the amount above spot price that you pay for actual coins or bars, have been rising. When premiums rise, it means physical demand is outstripping supply. It means people want the real thing, not paper contracts. And this is happening globally. In India, one of the world's largest silver markets, premiums have spiked. In Europe, the same story. Physical silver is becoming harder to source at reasonable prices, even as the paper price breaks to new highs. Now, let's talk about what's driving this from a macro perspective, because the fundamentals here are crucial. The dollar is under pressure, not just from inflation, though that's certainly part of it, but from a fundamental shift in how the world views the dollar's role as reserve currency. The BRICS nations, Brazil, Russia, India, China, South Africa, and now expanding to include others, they're actively working to reduce dollar dependence. They're settling trade in local currencies. They're building alternative payment systems. They're accumulating gold and other hard assets. This isn't conspiracy theory. This is official policy from some of the world's largest economies. When the dollar's role as global reserve currency is questioned, when countries start diversifying away from dollar-denominated assets, where does that money go? It flows into hard assets: gold, silver, commodities, real estate, things that can't be printed, that have intrinsic value, that have been recognized as wealth for thousands of years. And silver has a unique position in this shift. It's more affordable than gold, making it accessible to a broader range of investors. But it's also more volatile, which means bigger potential gains when the trend is in your favor. And right now, every indicator suggests the trend is strongly in favor of precious metals. Let me show you another angle on this. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1. That's the natural ratio at which these metals occur in the Earth's crust. But for decades, that ratio has been much higher. Recently, it's been trading around 80 to 1 or higher. That means silver has been dramatically undervalued relative to gold. Now, as silver breaks out, that ratio is starting to compress. Silver is catching up. And if history is any guide, when silver starts moving, it doesn't move gradually. It moves explosively. In 2011, silver went from $18 to $48 in less than a year. That's a 166% gain. And that was without the kind of supply constraints we're seeing today. Here's something else that's not getting enough attention. The paper silver market, the futures and derivatives, is enormous compared to the physical market. Estimates suggest that for every ounce of physical silver, there are hundreds of ounces of paper claims. This works fine as long as everyone's happy trading paper. But when people start demanding physical delivery, when they want to convert their paper claims into actual metal, the system can't handle it. There's simply not enough physical silver to satisfy all the paper claims. This is what's known as a squeeze, and we're seeing early signs of it developing. The premiums on physical silver are rising. Delivery times are extending. Dealers are having trouble sourcing inventory. These are all symptoms of a market where physical demand is overwhelming available supply. Now, I want to take a quick moment here, because if you're sitting on retirement savings, if you have $100,000 or more in traditional accounts, this is relevant to you. I've put together a free guide on how gold IRAs work, how you can get physical precious metals into your retirement account without triggering taxes or penalties. It's in the description below. It covers the mechanics, the rules, the things you need to know. Worth checking out if you're thinking about diversifying your retirement holdings into hard assets. All right, back to what's happening with silver. Because the breakout we're seeing isn't just about price, it's about a fundamental shift in how investors view risk and value. For decades, the financial system has been built on the assumption that paper assets, stocks, bonds, currencies are the primary stores of value, and for a long time, that worked. But we're seeing cracks in that foundation. Government debt levels are at historic highs. Central banks have printed trillions in new currency. The purchasing power of the dollar has been eroding steadily, and people are starting to question whether paper assets will maintain their value. This is where silver comes in. It's tangible. It's finite. It can't be printed or created out of thin air. And it has thousands of years of history as a store of value and medium of exchange. When confidence in paper assets wavers, when people start looking for alternatives, silver is one of the first places they turn. And we're seeing this play out in real time. Retail investors are buying silver coins and bars at record rates. Institutional investors are adding silver exposure to their portfolios. Even some family offices, the investment vehicles for ultra-wealthy families, are allocating to physical precious metals in ways they haven't in decades. But here's what makes this moment particularly significant. The last time silver broke above $50 in 1980 and again in 2011, it eventually pulled back. The 1980 spike was followed by a decades-long bear market. The 2011 peak was followed by years of decline. So why should this time be different? The answer lies in the supply-demand fundamentals. In 1980, silver was primarily an investment and monetary metal. Industrial demand was relatively modest. When the investment mania ended, demand collapsed and prices followed. In 2011, industrial demand was growing, but mine supply was still adequate to meet it. The investment surge pushed prices up, but when that surge reversed, prices fell. Today we have a different situation. Industrial demand for silver is not just growing, it's accelerating. And it's not discretionary demand that can be easily reduced. Solar panels need silver. Electric vehicles need silver. Electronics need silver. This demand is driven by long-term technological and environmental trends that aren't going away. At the same time, mine supply is constrained. Silver is often produced as a byproduct of other mining operations: copper, lead, zinc. When those base metal prices are low, silver production suffers, and even when prices are high, it takes years to bring new mines online. The supply response is slow and limited. This creates a situation where even modest increases in investment demand can have outsized impacts on price. Because the market is already tight from industrial demand, any additional buying pressure has nowhere to go but up in price. Let me give you a specific example of how this plays out. China is the world's largest producer and consumer of silver. They're also installing solar capacity at a staggering rate. In recent years, China has gone from being a net exporter of silver to a net importer. They're consuming more than they produce. And as their solar build-out continues, that import demand is only going to grow. Now, China is also accumulating gold reserves at a rapid pace. Their central bank has been buying gold every month for years. While they're not officially accumulating silver reserves, the industrial demand from their economy is effectively removing silver from the global market at an accelerating rate. This matters because China's demand is price inelastic. They need the silver for their industrial production regardless of price. So as prices rise, their demand doesn't fall. It continues, and that puts a floor under the market that didn't exist in previous cycles. Here's another factor that's often overlooked. The energy transition, the shift from fossil fuels to renewable energy, is massively silver-intensive. Every megawatt of solar capacity requires significant amounts of silver, and the world is planning to install hundreds of gigawatts of new solar capacity in the coming years. That's not a maybe. That's official policy from governments around the world. The International Energy Agency estimates that silver demand from solar panels alone could more than double in the next decade, and that's just one industrial application. Add in electric vehicles, 5G infrastructure, medical devices, and all the other uses, and you're looking at industrial demand that could easily exceed total mine production. When industrial demand exceeds mine production, the gap has to be filled from somewhere, either from above-ground inventories, which are already declining, or from recycling, which is limited and expensive, or prices have to rise high enough to either stimulate new production or reduce discretionary demand. And given the long lead times for new mines and the inelastic nature of much industrial demand, price is the most likely adjustment mechanism. This is why the current breakout in silver is so significant. It's not just a speculative move, it's the market beginning to price in a structural supply deficit that's going to persist for years. Now, let's talk about what happened in 1980 in more detail because there are lessons there that are directly applicable to today. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, started accumulating silver in the early 1970s. They saw inflation destroying the dollar's purchasing power. They saw political instability around the world, and they decided that hard assets, particularly silver, were the place to be. They started buying physical silver. Lots of it. They took delivery of futures contracts, which was unusual. Most traders just roll their contracts forward. They never actually take possession of the metal. But the Hunts wanted the real thing. And as they accumulated, the price started rising. Other investors noticed and started buying. The move fed on itself. By January 1980, silver hit $50. The Hunts had made billions on paper, but then the system struck back. The exchanges, under pressure from the government and large banks that were short silver, changed the rules. They raised margin requirements dramatically. They limited the number of contracts any single entity could hold. They made it nearly impossible for the Hunts to maintain their positions. The Hunts were forced to liquidate. Silver crashed. They lost everything. The lesson that most people took from this was that you can't fight the system, that trying to corner a market will end badly. But there's another lesson that's more relevant today. The system will change the rules to protect itself when threatened. And here's the thing. The system is far more vulnerable today than it was in 1980. Government debt is exponentially higher. The financial system is more leveraged. The derivatives market is vastly larger. And the dollar's position as reserve currency is being actively challenged in ways it wasn't back then. So when silver starts moving, when the paper market starts getting squeezed, the system's ability to respond is more limited. They can't just raise interest rates to 20% like Paul Volcker did in 1980. The debt burden is too high. The economy couldn't handle it. They can't easily change exchange rules without triggering a crisis of confidence in the entire derivatives market. This means that when silver moves this time, the dynamics could be very different. The system's tools for controlling the price are more limited. And the fundamental drivers, the supply deficit, the industrial demand, the loss of confidence in paper assets, are more powerful. Let me show you what some of the smart money is doing. Major hedge funds have been building positions in silver miners. These are companies that produce silver, and their stock prices tend to leverage the moves in the underlying metal. When silver goes up 10%, silver mining stocks might go up 20% or 30% or more. The leverage works both ways, of course, but for investors who believe silver is heading higher, the miners offer amplified exposure. And it's not just hedge funds. Family offices, the investment vehicles for ultra-wealthy families, have been adding precious metals exposure. These are sophisticated investors with access to the best research and analysis. They're not chasing momentum. They're positioning for what they see as a fundamental shift in the financial landscape. There's also been significant interest in physical silver from retail investors. Coin dealers report that sales of silver eagles, silver maples, and other popular coins have been strong. And importantly, these buyers aren't flipping the coins for quick profits. They're holding them. They're treating silver as a long-term store of value, not a trading vehicle. This matters because it removes supply from the market. Every ounce that goes into a safe deposit box or a home safe is an ounce that's not available for industrial use or for other investors. It's effectively a reduction in available supply, which puts upward pressure on prices. Now, let's talk about the geopolitical dimension, because this is crucial to understanding where silver is headed. The world is fragmenting. The post-World War II order, with the dollar at its center, is being challenged. Countries are forming new alliances, building alternative payment systems, reducing their dependence on Western financial infrastructure. This isn't happening because these countries don't like the United States. It's happening because they've seen what can happen when you're dependent on a system controlled by someone else. They saw Russia get cut off from SWIFT, the international payment system. They saw assets frozen, sanctions imposed, and they realized that having all your eggs in the dollar basket is a strategic vulnerability. So they're diversifying. They're accumulating gold. They're settling trade in local currencies. They're building new institutions like the BRICS Bank. And while they're not officially accumulating silver, the industrial demand from their economies, particularly China and India, is removing massive amounts of silver from the global market. This geopolitical shift is a long-term trend. It's not going to reverse next month or next year. And as it continues, it's going to put persistent pressure on the dollar and persistent support under hard assets like gold and silver. Here's something else to consider. The United States government has massive silver reserves, or at least it used to. In the 1960s, the U.S. had billions of ounces of silver, but over the decades, those reserves were sold off. Today, the strategic silver reserves are essentially zero. The government sold the silver when prices were low, and now that prices are rising, they have no reserves to stabilize the market. This is different from gold, where the U.S. still holds over 8,000 tons in Fort Knox and other facilities. With gold, if prices spike, the government theoretically has the option to sell reserves to calm the market. With silver, they don't have that option. The market is on its own, and this matters because it means there's no official backstop. If silver starts moving parabolic, if we see the kind of price action we saw in 1980 or 2011, there's no government stockpile to release into the market to moderate the move. The only limiting factors are mine production, which is slow to respond, and recycling, which is limited and expensive. Let me paint a picture of what could happen if this trend continues. Imagine silver at $75, then $100, then higher. At those prices, every industrial user of silver is scrambling to secure supply. Solar panel manufacturers are paying premiums to lock in deliveries. Electronics companies are redesigning products to use less silver. Investors are piling in, afraid of missing the move. The paper market starts breaking down. Futures contracts are settled in cash instead of physical delivery because there's not enough metal available. ETFs struggle to source the silver they need to back their shares. Premiums on physical coins and bars explode to 30%, 40%, 50% above spot price. This isn't science fiction. This is what happens when a commodity market with inelastic demand and constrained supply meets a surge in investment interest. We've seen it before in other markets, and the conditions are aligning for it to happen in silver. Now, I'm not saying this is guaranteed. Markets are unpredictable. There could be a recession that reduces industrial demand. There could be a major new silver discovery that increases supply. There could be technological breakthroughs that reduce silver usage in key applications. Any of these could change the trajectory. But based on what we know today, based on the supply-demand fundamentals, based on the geopolitical trends, based on the loss of confidence in paper assets, the path of least resistance for silver is higher, potentially much higher. And here's the key insight. You don't need silver to go to $100 or $200 to make significant returns. If you're buying at $53 and it goes to $75, that's a 40% gain. If it goes to $100, that's an 88% gain. Those are returns that can meaningfully impact your financial situation, especially if you're allocating a reasonable portion of your portfolio. The question isn't whether silver will go straight up from here. It won't. There will be pullbacks, consolidations, periods of doubt. The question is whether the long-term trend is in your favor. And right now, every indicator suggests it is. Think about your own situation. If you're holding cash, you're losing purchasing power to inflation. If you're in bonds, you're getting yields that don't keep pace with real inflation. If you're in stocks, you're exposed to a market that's at historic valuations with significant downside risk. Where's the asymmetry? Where's the opportunity for outsized returns with limited downside? Silver, at this moment, offers that asymmetry. The downside is limited by industrial demand and production costs. Mines can't produce silver profitably much below $20. Industrial users need the metal regardless of price. So there's a floor. But the upside? If we're entering a period of dollar weakness, if the supply deficit persists, if investment demand accelerates, the upside could be substantial. This is what the smart money understands. They're not trying to time the exact bottom or top. They're positioning for a multi-year trend that's just beginning. They're accumulating physical metal, buying mining stocks, adding exposure in ways that will benefit if silver continues its breakout. And the breakout we're seeing right now, silver trading above levels not seen since 1980, this isn't the end of the move. This is likely just the beginning. Because the fundamentals that are driving this, the supply deficit, the industrial demand, the geopolitical shifts, the loss of confidence in paper assets, these aren't short-term factors. These are structural changes that are going to play out over years. So when you see silver at $53, when you see headlines about prices not seen in 45 years, don't think you've missed it. Think about what happened after 1980. Think about what happened after 2011. And then think about how this time is different, how the supply situation is tighter, how industrial demand is stronger, how the geopolitical environment is more supportive of hard assets. The opportunity in silver right now isn't about catching a quick trade. It's about positioning for a fundamental shift in how the world values money and assets. It's about recognizing that we're at an inflection point, where decades of monetary expansion and dollar dominance are giving way to a new paradigm. And in that new paradigm, hard assets like silver are going to play a much more important role. This is your moment to pay attention, to do your research, to understand what's happening and why, and to make decisions that could protect and grow your wealth in the years ahead. Because what's happening in silver right now, this breakout above levels not seen since 1980, this is a signal that the market is waking up to realities that have been building for years. And the investors who recognize this signal early, who position themselves accordingly, they're the ones who are going to benefit as this trend unfolds.